Welcome. It is Wednesday afternoon, January 7th. We've already made it 1 week deep into this new beautiful year. Hope you're off to a good start and that you finish 2025 in good fashion as well. So I have here a 3-year chart on the S&P 500. And if we look at the start and we go each year has been successively higher. We've been in a pretty good uptrend. If you knew 3 years ago that you could buy in at approximately 4,000 and sell at approximately 7,000, for most people that would be a pretty good idea. There were some bumps along the way, and it can be really tough to keep your cool when the markets are moving against you, even if you have a good long-term perspective. Let's knock this down to a 1-year chart, and we can look at that in even bigger detail. This was primarily in reaction to tariffs. One of my friends called it a tariff tantrum. I thought that was rather clever. But when a tariff gets imposed, a tax is put on a good that is coming into the United States. And companies can't afford to absorb that. They'd go out of business. So the companies that are doing the exporting to the U.S., they raise their products, usually in proportion to the tariff. So now there's a higher price, and the consumer, that's you and me, if we still want that good or service, we have to pay the higher price for it. That can be inflationary. And we don't know how bad or how long or how strongly Trump was going to hold the line. He's a pretty good negotiator. So sometimes he will ask for more than he knows he can get just to have a starting point or some space to negotiate from. So we took an initial down, rallied, said, nope, we're not out of the woods yet. Down we come. And the thought process, of course, is by making these foreign products more expensive, our domestic industry will have more of a chance to grow within that industry or within that segment. That will in turn provide more jobs and more income, homegrown, and staying here locally. So there's a lot of arguments that can be made about free markets. They work best when everybody is playing that way, not just a few. But there's a potential that if we survive these inflation shocks, that the economy will grow bigger, faster, better going forward. That appears to be what the stock market is banking on. So far, so good. Now, I'll talk more about this as we go on, but I am bullish not only for this year, but for at least the next 3 years counting this year. And by bullish, I not only think the stock market is going to go up, but I think we are going to have above average years. Now let's talk about some of the things that can be market movers. Okay, first, let's look at the Federal Reserve. We'll just call them Fed for short. And I'll take a step back here. For a stock market or a stock to move higher, there has to be buying pressure on it. More people, or at least more money, has to be trying to buy it than sell it. Very simple, but in the end, that's what we're trying to figure out. Are more people going to want to try and buy? More so than those who are trying to sell. If we have that, the stock or the stock market or whatever will move higher. Okay, so is there going to be enough money for us to do that? The Federal Reserve has 2 mandates: maximum employment and stable prices. Sometimes the two are in conflict. You saw Fed chairman talk about that in the most recent meeting, if you happen to watch it. The Fed can do 2 things. They can control the money supply and they can move interest rates up or down. As they increase the money supply, they add liquidity into the system. That usually accelerates an economy, but can lead to inflation. Now, if we just look at that, if we look at the Fed's balance sheets over, say, where they were in 2022, they're about 5 billion lower. So there is less money in the system, less liquidity in the system than there was in 2020, a little more than 3 years ago. But it's still at 2.9 trillion. There's still plenty of money out there for people to get out there and make their purchases and push the stock market up. Now, this is from the most recent release, most recent information from the Fed. When auction comes up, this is them talking about their balance sheets and what they're going to do with the treasuries that are already there. They're not going to close them out. They're going to roll them over. They're going to reinvest principal payments back into agency securities and treasury bills. Now, for a while, they were reducing their balance sheet. At the moment, it looks like they're going to keep it stable. Okay. Now, next thing that is at least on my mind is Fed Chairman Powell. His term expires in May. President Trump has hinted more than once that he might want to make a change there. And making a change might actually be a soft way to say it from some of President Trump's verbiage. But we'll see. But another question, does Fed Chairman Powell even want to stay? Looks like I missed an L there, I apologize. Does he even want to stay? He's been a little bit vague about that. So even if President Trump is willing to stick with him, is Chairman Powell willing to stick with it? It's a lot of pressure in that job. So we'll see how all of that plays out. But what the Fed does, both in money supply and in interest rates, has a huge impact on the stock market. The size of the money supply usually doesn't get that much attention, not as much as I think it deserves. Everybody is always focused on the interest rate. So inflation, we'll look at some numbers here in just a minute, but can we keep lowering inflation down towards our target of 2%? Now, why not target zero? And I'm going to talk about that when I talk about in employment as well. Well, because if we do take it to zero, then we're too close to disinflation. Once we get it down to around 2% and the economy is doing well, that seems to be pretty stable prices that we can live with and we can manage going forward. And this time by manage, I mean people like you and me trying to keep a roof over their heads and buy groceries, prepare for retirement, those kinds of things. Okay. So we don't want to see inflation absolutely go down to zero. 2% over the long term has proven to be a very good target. We need people working. We need our economy to be producing. Ideally, more people will work and the economy will grow. But what exactly is maximum employment? And how close do we have to get close enough? We'll look at a table in a moment here. But just as we saw with this 2% goal for inflation, if we absolutely 100% had everybody working, it would actually be harder for a company to grow because there wouldn't be enough money to expand. A brother-in-law of mine has a business, and a few years back, he advertised for a position. He had 2 unqualified people apply for it. It slowed the growth of his business down because he just couldn't get good work, if you will. 6 months later, a year later, something like that, he posted for the same position and had more than 50 qualified applicants. But my point is, obviously if you're the one that doesn't have a job and you want one, it's a little tough. But we're going to have a hard time getting this one down to zero, and we probably don't want to. We want enough workers that every company that needs an employee can get one. GDP. What's the most we can get without becoming inflationary? As a general rule, if you grow too fast, you're going to have inflation. So we want to be aware of that. Okay, what I have up here is the federalreserve.gov website. More specifically, I've gone into their calendar for their FOMC meetings. Here's what we're going to be looking at in 2026. But here's what I want to look at. I want to go back to their last meeting of 2025, and I want to bring up this table of information. Now here is where the Fed makes their projections. I'm going to see if I can't make this a little bit bigger. And if I do that, I sacrifice some of the numbers. So we'll leave it right there. That's going to have to be good enough. Okay, so we talk about GDP, unemployment rate, inflation, core inflation, and projections on the Fed fund rate. Notice that they have a September projection for all of these, and now they've updated to a more recent projection. And here's what I'm most concerned about on these. Now we'll look at separate tables for some of these and go into a little more detail. But when it comes to GDP growth, we have increased our projection since September. Now let's hope that that really holds, because remember, we had the government shutdown, and so some of the information that we would have liked to have had along the way, we didn't. But we did increase, especially for next year. Now going back to the tariffs, this could in part be a reflection of the aftermath of the tariffs, if you will. It does look like we survived without it hurting or increasing our inflation too much. There's a better than average chance that it does bring more industry, more jobs to the U.S. And so for a season, we could have some extra good growth. Now, real GDP means it's adjusted for inflation. So the actual GDP be a little bit higher. A good number here again in 2027, and then kind of coming back to Earth again. If we could get real GDP of 1.9%, we would probably be in really good shape. Everything is a little bit higher than what we saw in September. Now the unemployment rate, we'd rather it go down. Here it's the same, here it's the same. Here it did go down, projecting our unemployment rate to get a little bit better. Here it stayed the same. The next two are related to inflation. Perhaps a little bit of an increase here from where we were. It's down overall, right? It's headed towards that 2% that we're hoping to achieve. But next year could be a little bit higher than this projected path, but then we catch up in the year after, and hopefully we do achieve that 2%. Fed funds rate, they see going down to about 3. That's probably a good stable level for it. Okay, let's go down to the next table. And let's see. Now let's stay here. Here's what we actually did with our GDP. Here's where we're looking. Those numbers, good. They don't scare me very much. I've skipped down to the unemployment rate. I want to focus here on the median, and you can see it's right around in that same range. That seems to be about where we could live with. We get much down here to 4 or below 4, and it just doesn't seem to be quite as healthy for us as it is to be in about that mid to low 4-point range. Next we have inflation. Notice that we are certainly a lot lower than we had been back here. Working our way towards 2. Still the forecast is for us to get to 2 and for an incremental increase And finally, interest rates. Here's where we ended up. And you can see of those who were giving their forecast, the largest number right here, about where we ended up. As we go out to the next year, you can see a wider disbursement. And some, putting it all the way down here, I really hope that this is not accurate. If we suddenly have to move that low, it would mean that we're in some type of a recession and we really need to stimulate the economy. That would almost surely be inflationary. So I really hope that those guys are wrong and we do not go down that far that fast. But to gradually go a little bit lower, that would be good. And you can see that we get a lot more numbers down in this range and fewer number, much smaller right here. Again, the weighting begins to move a little lower in 27, a little lower still in 28, but also tighter. And then finally, we end up with our biggest number at about 3% for the longer term. All right. Now I've gone back here to looking at the S&P 500. This is my favorite barometer for how the stock market as a whole is doing. There's certainly other indexes you could look at, some that are broader, some that focus on a different size of security. S&P 500 is your largest 500 by market cap, so it heavily favors older, more established companies. Oftentimes they have slower growth, usually pay a little better dividend. But I really think that this year, next year, and the year after, through 2028, I think we're going to continue to see strong 10% plus for each of the next 3 years. We will see some volatility, but overall, I think the future looks very bright. All right, good luck out there.